With certain bank CDs paying more than 5% APY and some savings and money market accounts paying close to that amount, as of June 2023, it's hard to blame investors for wanting to maintain a sizable portion of their retirement assets in cash and cash equivalents. However, if you're not careful, those high interest rates could cost you money in retirement. Keeping big cash allocations for a year or two can make sense to fulfill your short-term retirement income goals, writes Amy Arnott, a certified financial analyst, CFA, and portfolio strategist for Morningstar Research Services. Beyond that time horizon, cash can be particularly detrimental to long-term investment goals such as retirement. According to Arnott, a retiree who started saving $10,000 per year in 1993 and stashed everything in cash would have ended up with around $380,000 by the end of 2022. Compared to about $1.5 million if the savings were invested in an all-equity portfolio or $1 million if invested in a balanced fund. Rising rate cash accounts should be avoided since their interest rates tend to rise during periods of rising inflation. In today's scenario, rates have risen as a result of the Federal Reserve's decision to raise rates 10 times in the last 16 months in order to combat increasing inflation. As the Fed raised its benchmark federal funds rate from 0.25% in early 2022 to 5.25% in May 2023, keep in mind that inflation was running at an annual rate of 8.54% when the Fed began. With inflation already hovering around 4%, bank savers can earn a tiny profit on high-yielding accounts, but this won't last long. Furthermore, the rates banks pay often trail the Fed's set rates, as they have for the most of the post-pandemic period, making any significant profits following inflation a fleeting occurrence at best. One-year CD rates are now higher than 5-year CD rates, indicating that bankers expect the Fed to pause or even decrease rates when the cost of living falls. Keeping an all-cash portfolio holds the potential of automatically losing the value of your money through inflation and income taxes. This often can lead to negative returns but is masked by ever-increasing numbers in your portfolio's value. Reasons to keep cash. Financial advisors urge their customers to invest in the stock market because beating long-term inflation with cash is practically impossible. Only stocks have historically showed the potential to generate returns after inflation over long periods of time. As interest rates decline, cash is likely to revert to being one of the least loved forms of assets in its historic role as a financial parking lot. That is, it is a vehicle in which investors store funds for immediate or short-term purposes. Cash accounts, on the other hand, can shine when used properly, including the following. 1. Funds for emergencies. An emergency fund should be safe and easily accessible, whether it is for 3 months or a year or more. CDs, savings, and money market accounts are frequently suitable for this purpose. 2. Short-term requirements. The bucket approach to retirement investment divides assets into long-term, medium-term, and short-term buckets based on when retirees will need the money. A year or two of living costs in cash protects investors from market shocks and allows them to weather periods of stock volatility. It also reduces the risk of sequence of returns risk, which arises when a period of weak market performance early in retirement results in larger than average portfolio losses, making future retirement withdrawals difficult to sustain. 3. Budgeted spending. Savings for a down payment on a house, wedding expenses, or anticipated college tuition payments should not be invested in equities. This is especially true if the money is needed in the coming years, when a market collapse could cause money invested in stocks to fall short. 4. Purchasing thinking time. An inheritance, lottery winnings, unanticipated bonus, or other windfall can be parked in an FDIC-insured bank CD or money market account. This generates some interest while the receiver decides how to invest or spend their bounty. In conclusion, investors who need to keep some of their assets in cash should take advantage of the momentarily higher than usual interest rates on bank CDs and money market accounts. Remember that cash, as an investment, is just for covering projected short-term needs. How much do you have in your short-term cash account? What do you use this account for? What percentage of your investments is in cash? Leave a comment below. Take care and remember that your money matters.